Hello to everybody on the line. Going to give it another minute and then get going. All right, good afternoon, and thank you for joining the Energy Market Update. A special thank you for joining to all of our channel partners. Looks like it's shaping up to be a great Memorial Day weekend, which we'll get to later. But first of all, starting off like we usually do, we'll get into natural gas fundamentals. For those who don't know me, I'm John Vieira on the left. Natural gas fundamentals first, followed by market news, weather, and then finally with market data for the graphs. And we have our trusty legal disclaimer to the right. So taking a look at natural gas, we had an injection estimate of 97 at 100. About a half hour before the final estimates came out, it was 96 at 101. So yes, the injection did miss today, just below, coming in at 96, but nothing really totally unexpected for the market. More importantly is, how are we going to be set up for the fall going into the winter, especially for ICE in New England, PJM, NYISO, and MISO. So right now we're at a surplus 340 compared to the 5-year average, 340 BCF above that right now. And we know during 2022 we were at a deficit. We saw that big run on prices through the summer of 22 into the fall before prices came crashing down in January. So, and we know how quickly they can flip. So right now the blue line where we are now, indicated by the green arrow, has a lot of space above that dark gray line. It could easily flip as we take a look at the production here in the US versus what we're actually sending out of the country. Estimates for the coming week are looking at 102 to 112. So a little higher number there. We'll see if that actually happens or if those estimates start coming down during the week. New picture here, although it looks the same and the differences may seem very minuscule, but if you take a look at the red arrow for the production, for the orange line, you see it kinks down a little bit after the red arrow into the forecast. So the CN production may be coming off from kind of the highs we've been hitting. So yes, we've been hitting highs in production, maybe up 1, 2 BCF, but the LNG exports are outstripping that, not shown here. The other thing too from this graph is the tops of the magenta line or the reddish pink line are going over the top in the forecast into the future, showing that consumption's up. So demand going up a little bit more in the future. So production down, demand up, putting upward pressure on this forecast. So besides production, yes, it has increased slightly. However, LNG exports are growing exponentially. We've been hitting record highs over the past several weeks for how much LNG we're sending outside of this country. And we're expected to continue that. By 2028, some people have it at 21 to 25 BCF. Some have it even higher than that. So doubling the export capacity that we're doing right now. So in a very short time frame, how quickly that could cut into the supply picture here in the US. So that's why another reason to plan for those outside years sooner than later. And one of the last graphs we'll look at today, the price of the Houston Ship Channel into the future, you're going to see the outside years getting a lot higher with the expectation of this LNG leaving. And again, when people are asking, well, where's this gas going? Usually when you're here on the news, the different price points, national balancing point for the UK, the title transfer facility, the Dutch virtual trading hub used for the EU, and the JKM for the Japan Korean market going over to Asia. So taking a look at the confidence interval of Henry Hub. So this is how we want to kind of evaluate all of our graphs going forward, is basically what is the price going to go up or down from here is what a client wants to know, but also what's the likelihood of it going up and down. If it's a 50-50 shot, that's one thing, but if it's 80-20, what odds do you want to take going forward? So this graph at least describes, so the green and red arrow overlaid on the short-term forecast from the EIA just to help better indicate what the gray means. The gray means the upside risk of prices going up. The red arrow is indicating the downside risk of prices going a little bit lower. And as you can clearly see, there's only a little bit of gray below the line for prices, where there's a bunch, big chances for spikes in prices, which is what we're expecting now that most of our markets are close to the 52-week low and all the major markets are below the 52-week average. Taking a look at market news. So we keep hearing about problems with bringing offshore wind electricity online or the wind turbines being built. There was a lot of issues with bringing on the two Massachusetts projects that still aren't up, but have been pushed back. We had one company drop out, another one pick up the slack, saying they needed more money due to inflation, other economic costs, although they were getting plenty of subsidies and free money in the first place. But this is a growing issue. It's basically the left fighting against the left. Wind turbines good for clean energy, possibly bad for animals. So that's not proven. However, some pretty strongly worded letters to Congress from 50 mayors, at least 50 mayors from blue states, are basically saying that they believe that there's a connection between these offshore wind farms and the mortality of animals and marine life. And unless some science can prove otherwise, they do see the correlation of that, because there's no other variable that's changed during the time of their installation of why these deaths are occurring. So again, this is just another obstacle for bringing clean and green energy online. We don't know about the other impacts that could be happening. It may mean that supply comes online slower or needs more regulation or rules. Again, that just to us, it simply means the supply coming online is more at risk for renewables while we continue to shut down fossil fuels, really putting the next several years at risk. Also on land, there's been a big case about especially endangered eagles besides other birds. So it's not just offshore wind, but on and offshore wind. So we'll see if anything comes from that. The EPA continues to be on a tear for 2023. So on May 11th, they released some proposed rules, and more of the details have come out about them. But essentially, it would require all coal plants to have carbon capture sequestration or be totally retired by 2035. So pretty big line in the sand to draw, saying, hey, if you're a coal plant, you're not going to invest more money, you're out of business by 2035. Also very important, targeting natural gas plants, saying that they might need to co-fire with clean hydrogen, so natural gas and clean hydrogen at the same site by 2032 at 30%, and have some type of a ladder increase up to 96% by 2038. So this would be a huge change to the business for these natural gas plants. So it's putting coal and natural gas at risk, and that's for the future years, but not just the future, what's right in front of us, because if these companies need to make these investments or know they're going to be put out of business in just a short period of time, they might decide to retire early, like we're already seeing in PJM from the other rules that have emerged surrounding coal plants. So again, it's putting the supply at risk. Well, we're at currently market 52-week lows. It seems like a reasonable point to pick up at least part of that load, if not fix in. Another bullish story out there is NERC, the North American Electric Reliability Corporation, who does studies on the grid, just like FERC, CERC. There's a bunch of different fun acronyms, but all of them are supposed to be looking over the well-being of the grid. Their summer assessment report has most of the country at risk for reliability and resiliency issues if extreme conditions do arise. And again, extreme does not mean rare. I mean, you can go a summer with heat waves every week, or they could happen not at all. So that's totally up to what is in front of us for the summer. We're going to see in the weather. Most of our markets look at above average temperatures coming, and that's going to really heavily depend on how El Nino, not La Nina, does or does not form. So there are some reports out there, kind of self-assessments by the actual grid operators that say, hey, you know, we're going to do all right, but that's kind of like grading your own paper for your class when the teacher says it. So everyone's kind of giving themselves maybe a little bit better grades. NERC's kind of holding their feet to the fire, saying for assessment rules. And just to take a look at that on a graph quickly. So the bar chart, everything to the right seems like it's okay, which is pretty much none of our markets. As you see, Texas, New England, and most of the country at risk being to the left of the zero. So negative reserves during extreme conditions. And then to the last story on this slide, super important. It has been out in the news, but President Biden did go through and just vetoed the bipartisan legislation that would have overturned the solar tariff that he himself granted. That solar tariff was on China for solar imports for their humanitarian and environmental atrocities. Essentially, they said that they took Chinese parts, sent them to Southeast countries, rubber stamped them, and sent them to the U.S. to avoid these tariffs. It brought the entire solar industry to a standstill at the beginning of 2022 until he passed this waiver that goes for two years until June of 2024. Small chance it really does get overturned. However, he has vowed to not extend the waiver from this tariff past June of 2024. So what happens when June 2024 comes around, right? Where do we get this supply from? If the tariff continues, it makes many projects uneconomic. To be able to actually build and manufacture here with the cost of living is much higher than what you'd pay over in a Southeast Asian country or in China. So it would need a couple IRA packages of billions, hundreds of billions of dollars to subsidize something like that. So that seems unlikely. So it's a problem on the horizon that we have to keep a close eye on. And another reason why to lock in those outside years sooner than later. So this slide, again, has a lot of the details about that solar issue that's going through and whether how it materializes as we go to the future. The supply chain issue continues to get worse between U.S. and China right now. The relationship has not been going great. There has been a little bit of positive news over the visiting of the ambassador. However, when you kind of dove into what he was saying when he came here, he basically warned us of the serious difficulties and challenges that lied ahead and really highlighted the different stances of Taiwan between the U.S. being independent and China thinking it's part of them. And that's going to be a big problem if we don't resolve it or capitulate to China, which we'll see what happens. But either way, we depend on them for a lot of supplies. And as our Department of Interior said, that we're getting over 63% of our minerals for all these green projects from there. We're doing a lot of our mineral processing there that need to go into these green projects. So if they decide to cut us off at any point, basically our entire renewable industry is put at a standstill, and there basically puts our reliability and resiliency forecast for the next couple of years just totally gone. Just kind of like what happened to the EU overnight when Russia pulled the pipeline for Nord Stream 1. Just another summary slide on the EPA. So since the beginning of this year, they've focused on mercury emissions, strongest limits against wastewater, smog that travels across straight lines, tailpipe emissions, the list goes on and on. Death by 1,000 cuts, any way they can go against the fossil fuel industry. They did just lose a case at the Supreme Court again after losing in June last year for overreach of power. They just lost in court about something dealing with wetlands, with basically they're trying to expand their power day by day. It keeps having to go to the courts, but it's to say that they're going to keep up with this pace of trying to make rules, trying to shut down fossil fuels any way possible. So again, shutting down supply and maybe not being able to bring on new supply is definitely putting the next couple of years in flux. And as you can see for PJM, which would be very much affected, coal could be affected at 60% of the power plants shut down from these new rules. As you can see by the red arrow on the right, I mean, it's the third biggest supplier. And then this might also kill at least 30% of natural gas in PJM, and that's the biggest supply of electricity. So you lose your top 1 and 3 of supply for electricity. How do you replace that? And you can see how much smaller the wind and hydro are in those areas. And with all the topics we covered, again, it's making a lot of uncertainty for those outside years. Taking a look at the Russia-Ukraine war, things are still not going good. Obviously, each week you're hearing something new on the news. Last week it was the rocket attacks and the rocket attacks from Russia, and then the counteroffensive from the Ukraine. Well, the Ukraine counteroffensive seems to be working. They're actually driving the mercenary force Wagner out of Bakhmut, which has been a really highly contested region. And then on the more direct conflict versus the proxy war through the Ukraine, the U.S.-Russia seems to be getting worse as well. We just sailed the biggest warship in the world into the vicinity, which Russia is very unhappy about. So we'll see if anything else further escalates from that, and if it causes any more supply chain issues between the U.S. and Russia. Other than the actual energy, we know that aggressive net zero goals continue to be pushed. It seems like a case of one-upsmanship. Every state wants to be the leading, get into the green the quickest in the shortest timeline. Whether they're realistic or not, that's not really what matters. That's the stories they're putting out and the goals they're setting. So as these state compliances come out, if you're signed up beforehand, you have a good chance of getting grandfathered in for that renewable bucket. So might as well at least lock in your fixed adder if you're not convinced to lock in any portion of your energy. And this is kind of just that taste of reality. So if we look at Q4 2022 to the right, the chart, we see ICE in New England and PJM were both up less than 1% of renewables from Q4 of 21 to 22. So not these big leaps and bounds that have been talked about that we're going to hit. And we actually see that NYISO and ERCOT were less renewable year over year. So this is just taking, there's one thing with goals and there's another with actually putting steel in the ground and building out these renewable supply. If they don't come online, we shut down supply. That's really the big story that we're going to be dealing with the next 5 to 10 years. And again, another way to look at it, going into the future, looking at the green and black lines for wind and solar, the production coming from them is not skyrocketing up. They're kind of going flat, increasing a little bit. And if we go back to 2010 up till current year, we have not increased by more than 2% renewable generation a year. So the math really stops not working for those outside forecasts on such a short timeline for being renewable, unless some new technology comes out, which I'm not saying it can't, or some fundamental shift in the way the world operates, but very, again, unlikely scenarios compared to what is in front of us. Other renewables, taking a look at capacity for the PJM and ICE in New England markets. We're just about in peak notification season, which we're going to cover again in a second. But the last PJM auction cleared low yet again, as expected. It was highly subsidized. It's letting more assets in so they can offer in underneath their real costs. So expecting to keep a lid on prices for the coming years, lending itself a good strategy for most of our clients for capacity pass-through, especially those larger clients, IDR and such. The only area to avoid really is that DPL South green, a little bit unpredictable, not a lot of supply being able to build there. Big question mark is there's supposed to be another capacity auction for capacity year June of 2025 through May of 2026, run this upcoming June, right around the corner. PJM's pushing to delay it until maybe May of 2024. A lot of opponents are saying run the auction. Still holding our breath to see what happens there. ICE in New England, similar vein to PJM, putting in new rules already started. They're going to fully phase in for FCA 19 or phased out the way you look at it. Basically, more rules to allow subsidized assets and different types of renewable assets demand response into the capacity market. So it's supposed to keep a lid on prices like the last results just showed. Taking a look at weather. So May didn't exactly live up for the first half of the above average temperatures, closing out a little bit warmer. But June, July, August taking a look at basically all the eastern seaboard, so ICE New England, NYSO, PJM, and then down in Texas, looking at leaning above to likely above average temperatures. So big question is going to come down to heat waves and spikes as well, and then the overall temperature. But right now, it's looked like it could be hotter. The thing that could throw cold on water on it would be if El Nino does develop, and to what degree. However, still uncertainty now. Good time to lock in before price spikes come. If the LMPs start taking off late May, early June, expect July and August to really pop. And ERCOT could really feel that the most, as we've seen the August and July months bouncing around the most. Taking a look at weather for the Memorial Day weekend, looks like it's going to be beautiful, clear skies from all of our major markets. It's starting to heat up, starting to get those summer temperatures coming in. We'll keep an eye if any of the indexes do spike, because again, that's going to push forward to this coming summer, especially July and August. So in this type of market, low falling block and index, fixed data, locking in future terms, all different types of strategies are available. I mean, if they only expect prices to rise, fix in. If you only expect them to decline, index strategy. If you're not sure, low falling block and index really is a way to go. Helps you manage and also be the consultant for that client. Help update the small to medium clients if bullish stories do come out. If they think it's going to fall a little bit further, and if they're under contract, you can get that pricing request turned around quicker. And again, this is a free service for clients or prospects to sign up for the capacity peak demand notification. So it's on the Mantis website, so the client or prospect can do it themselves, or you can sign it up for them. Legal just asks that you get an email saying that they want it to be signed up for it, so they can't say it was spam. But again, really can save you hundreds of thousands of dollars for maybe 16 to 30 hours of turning down use that you would save on 8,760 hours during a normal year. So huge amount of money that could be saved depending on who your client is, but at least something to explore and say that we have available. It might be a nice way to get a prospect to dig in a little further. Taking a look at market data. Again, right now, we're leaving utility winter rates that obviously by comparison are much higher because they only include the winter months, not the summer months. Now that we're coming up against the utility pitch of, oh, our rates are so much lower. Well, no, the rates aren't lower. They're just, their term is shorter. So it doesn't include the winter months. And we need to be able to dispel this notion with clients when showing them a 12 and 24 month with this picture. Yes, if you don't include the months of December, January, and February of 24, obviously, if your price is only June 23 to October 23, whatever the dates are, the price is going to be much lower than if it's included. So that hopefully will get you past that objection when talking about rates. Taking a look at the ICE in New England balance of the year, so that's June to December, soon to be July to December as we enter June. But for now, June to December balance of the year was off 2 mils week to week, still close to that 52-week low. And again, if you look at the short-term graph, it's kind of moving left to right, slowly coming off. What we're worried about is a pop from any of these big stories coming, or the weather getting bad and, well, getting hot for the summer. Taking a look at ICE New England County at 24, off 2 mils week to week, now closer to the 52-week low after a little bit of a rally in April. Algonquin gas was off a cent week to week, still close to the 52-week low. And again, kind of moving left to right since we were in January, about just around the same spot. What we're worried about is hitting, the peaks of what it was during last summer and into the fall. Algonquin County at 24, off a half-cent week to week, still close to the 52-week low. So PJM, similar style to ICE New England, want to be able to talk about a 12-month rate versus just the summer rate and why that difference is there. This visual should help with clients. And then PJM balance of the year, June to December, was off 1.5 mils week to week, still close to the 52-week low. And we have calendar year 24, PJM was off 0.5 mil week to week, now closer to the midpoint between the 52-week low and average after kind of making a push now twice, getting close to that 52-week average, which part and due to some of these rules coming out from the EPA. Taking a look at using TETCO M3 for PJM gas, was down less than 0.5 cent week to week, still close to that 52-week low, pretty much right there. Great place to pick it up. And calendar year 24, I mean, a little bit higher compared to the low, but still hanging at a very low point. So up a half cent week to week. ERCOT, on the other hand, summer, now that the Storm Uri fears and all the rules they're trying to make to solve that problem seem to subside a little bit. We still see January and February 24 a little bit higher than they used to be historically, but we've returned to July and August being the most expensive months during the year. A little fear come when we take a look at July and August of 23 versus July and August of 24. So we just saw August 23 creep back underneath the 8-1 mark, kind of 7.9 right now. I mean, that's been as high as 120. So we have to keep an eye on that. Again, if the heat comes, we start seeing those index prices pop up. We're going to expect June, August 23 and 24 both to pop off. So a good point to get them before the summer heat does really kick into effect. Take a look at ERCOT balance of the year, June to December. Off 1.5 million week to week after establishing a new 52-week low on Tuesday. And then calendar year 24, Houston load zone off a 0.5 mil week to week, still right close to that 52-week low. So very strong place to pick up to try to take some of that risk off the table before that summer heat starts scorching. Houston Ship Channel, taking a look balance of the year for ERCOT, up a 0.5 cent week to week, but still close to the 52-week low. And calendar year 24 for Houston Ship Channel was flat week to week, still close to the low. And again, Houston Ship Channel, Henry Hub are neighbors. So those prices and charts look very similar to each other. But as we move geographically around the country, the basis continues to widen the more you go to the northeast. So Algonquin for ICE in New England in blue, red for PJM, gray being the Henry Hub. See the most volatile as you continue to move up, with ISO in England really kicking around. So when those lines get closer together, great time to lock in basis because they could just blow back out, meaning get wider between gray and blue or gray and red. Just more under a microscope. ICE New England not on the chart, but the green for Houston Ship Channel actually slightly cheaper than the Henry Hub. Looking out into the future, taking a look at ICE in New England. 24 was off 2 mils, 25 was off 1 mil, 26 1.5 mil. Outer years were all flat. So a little bit of a creep down. We've seen that past couple weeks. Mill or two up, mill or two down, kind of moving left to right. Again, what we're worried about is it's getting a lot of support, meaning how much lower can it go from here versus it could blow a lot higher. Algonquin, a similar picture for gas. And then for those multiple years, same way that you want to explain the three graphs is with these several lines. How high can it go? The dark navy line. You know what I mean? How low can it go? Let's look back to, 124, 2022, before everything kicked off with the Russia, Ukraine, and all the other issues, where easy energy policy changed over as the White House did to shutting down supply and trying to build renewables with all these supply chain issues. We've seen the prices reflect that. So how much lower can we go without another pandemic shutdown? We shouldn't get to those lows, but we sure could go higher. So that's the way we want to be describing these line graphs, just to let people know the risks of the up and down. Taking a look at PJM out into the future, we saw 24 through 26 off a 0.5 mil. The outer years didn't really move at all. We're seeing the years get more expensive going out into the future, where just a while ago, the prices went the other direction. A lot of these new rules coming out from the EPA and other federal levels, putting more pressure on those outside years with the uncertainty of, will there be supply, or are we going to run into big issues? So again, outside years, navy blue was the peak of where 2023 hit before we started the year. Now we have 2024 upcoming because we're in balance of 2023. So the magenta, light blue, light green lines, that's what we're talking about, where they go into the future. As you can see, that obviously the blue line stops as soon as the year started, and then it turned to balance of the year. So for apples to comparison, we just have it stopping at the end of 2022. But we want to use that as a reference point of where prices could go from where they currently are. Lastly, ERCOT taking a look into future using Houston load zone, 24 and 25 off a 0.5 mil. Outer years were pretty flat. Right now, 24 is a mil cheaper than 25. And lastly, the graph kind of going into that LNG story that I mentioned at the beginning. As we see, prices getting a little bit more expensive going in the future, actually eclipsing the gray bar. So I know we've been used to, seeing a lot of these bar graphs, the gray bar towers over those future years. Well, that's not the case here. And that's what we're worried about flipping for all of our other markets and starting to get excited by all these bullish stories that are continuing to gain momentum. And lastly, look at the line graphs that we want to be using for ERCOT electricity and natural gas. So some points to consider in conclusion. Again, we want to manage risk by evaluating how high or low the market can go and what's the probability of it moving up or down and for how long. Evaluating those longer terms, seeing if it's worth taking advantage of future years with where prices are now and where they could be. Being able to talk about a utility rate for a short term versus 12 or 24-month term is very important now, especially for our Northeast Mid-Atlantic markets, and being able to explain the value of, even though if the winter is included, yes, the price is higher, but those winter months are at 12-month lows, and they easily can pop right back to double what they were, which they were in ISO New England PJM just a few months ago. We've had the big drop since the end of last year to the start of January of this year. Most all of our markets are close to the 52-week lows, so great point to take off at least some of that risk, if not locking in all a portion of the energy. The whole government push to going green continues to speed up. We're expecting more of the same. So really the big question is, if we keep shutting down fossil fuel supply and not being able to bring on new supply, we're going to be in a tough spot. So we need to keep an eye on that. And lastly, differentiation, talking about other price components, how to maximize capacity, maximize renewables through the fixed adder to bring up with clients is another way to help show value. Thank you everyone for joining. I hope you have a great Memorial Day weekend. And if you have any questions, please reach out to your account manager. Have a great day.